All right, and welcome to Mark's Trading. We're really excited today to talk about technical analysis, what is it, and some of the pros and cons in using it. Let's get started. All right, before we start, number one, technical analysis is only a tool. It's a great tool if it's used properly, but it certainly has no holy grail. There are no secret signals or patterns. If you're using basic, commonly followed indicators that are on a standard charting package, there are no secret patterns or signals. Yes, if you're a PhD quant from MIT and you're using high frequency trading, okay, sometimes then possibly there are some higher outcome setups and probabilities, but believe me, if you're using a standard charting package, the likelihood that you're going to diversify away from the crowd using standard time series technicals is very, very slim. Number three, we love technicals, but we want to use them in conjunction with a catalyst. That catalyst could be earnings, it could be a secular story, it could be the Fed, whatever it might be. Use technicals around a specific catalyst. All right, so why are technicals more important today than ever before? Well, you have more quantitative system traders out there trading and with more capital than ever before for a number of reasons. And because there's more capital in the system chasing price series, it has more influence on how technicals behave in the marketplace. JP Morgan, as we mentioned, did a study in 2017. 60 to 70% of all intraday trading comes from the quants. Now, I would assume most of that is high frequency trading. It's a different animal that's done in milliseconds. But the large funds that have the most amount of capital within the quantitative world, they can't deploy all their capital intraday. So they're using longer frequency, trend following, machine learning, deep learning, neural network signals, but all of these signals are based on price series. They're not using fundamental catalysts. Now, there are some simple quantitative funds out there like Smart Beta. They'll use some fundamentals and they'll use some longer term momentum, but the quants that are moving the markets are based on price series, and that's essentially technicals. All right, let's get started here. Number 5, the only way to have a true edge using price series or technicals is to diversify away from how everybody else is looking at their indicators. And the problem is, if you're using any standard charting package and the hundreds of indicators on there, everybody else has access to those too. So the only way to really have something that has an edge is to diversify away from commonly followed indicators. That's why I am not a big proponent of a 200-day moving average or very simple patterns. All right, so what is technical analysis? It is the basic study of historical price in its attempt to forecast the future direction of an index, anything that has a ticker. Now, granted, the more historical data you have, the more confirmation you will have into the future of a stronger trend. We'll go into the issue with that in a minute. Number 2, the issue is with technicals that it can only consider, and it only knows all the information that is built into the market or the stock on any given day. It has a very limited ability to predict earnings or the future outcome of any events. Looking at past data also tends to lag significantly. So the stronger the trend, the more data or historical data you need, like a 200-day moving average. That's a very good indicator if a stock is going up. Unfortunately, by the time the 200-day moving average breaks, it's too late because it's lagging significantly with all that historical back data. We'll go into a really good example later on talking about that. Also, technical patterns do tend to repeat themselves. That is true. There's been a lot of case studies done on that. However, they have a tendency to have a large variation and be subjective. So what I mean by that is sometimes the patterns work and sometimes they don't, and sometimes you have to overly curve fit why the pattern has worked or hasn't worked. So I would say you'd be lucky to find any pattern that has a high predictability rate of more than 50%. And we'll go into predictability and probabilities later on. Lastly, I have to say, watching so many and being around this industry for so long, and you see people trying to sell books and indicators, anyone that says they have a secret pattern or a secret signal, they don't. Run far away. The only thing that makes a signal better is its ability to remove noise, random noise. So the better a signal, the better its confirmation, the more robust. It keeps you in a trade much longer. And that's what makes a good signal, not its ability to have some type of secret pattern where a stock is going to move exponentially. All right, now let's get started. All right, what are the concepts of technical analysis? Well, number one is momentum. I like momentum. Most people think of momentum on many different time frames, but the truth is it's really the rate of change, and typically the rate of change over a longer period of time. Most quants, most institutional investors use a 6-month, a 12-month, or even a blended look-back period on multiple time frames to create some type of composite score that we'll go into. But the point is, they'll look and say, okay, what has the greatest return on a 6-month look back? What has the greatest return on a 12-month look back? And that essentially is momentum. And many of you will also know what we've looked at in terms of called relative strength. Not the RSI index, but relative strength. Now, many funds, and this is why momentum is so important today more than ever before, because you have $1 trillion out there sloshing around that's following and scoring momentum. So for example, a very simplistic strategy, which is smart beta, many of you might have heard of, or factor-based investing, they all use momentum, and they're all looking at momentum basically on a 12-month look back. So more and more capital, more investors are pouring money into these ETFs, and they're all buying these higher momentum stocks. So that pushes up these stocks significantly, and they become crowded, and that's a whole different story. But at the end of the day, a lot of these funds will come up with a scoring methodology, and they'll say, okay, I want a stock that has these fundamentals that are really showing strong cash flow and revenue growth, and then also they have to be in the top quartile of momentum, or the strongest names within, let's say, technology that are positive in terms of EPS growth. All right. Now, there is, and you should go, and don't take my word for it, and look online and go find the research that has been done by a lot of PhDs on momentum and its predictive power. And there's hundreds of years worth of studies. And momentum does have the ability to have predictive power. And while no one really has shown the data why it has predictive power, my theory is companies that are showing positive earnings growth, the momentum keeps moving for the following 6 and 12 months. All right, so now that was momentum. Let's go to the next concept. Breakouts. I love breakouts, and breakouts essentially are just penetrating a support resistance level. Keep in mind, you can have support resistance levels on a minute chart to a weekly chart. The greater the time frame, the more supply and demand will be at that support and resistance. So I love breakouts that also are coupled with a good fundamental backdrops of a story. Let's say there's a new product coming out, let's say a new CEO, let's say for the first time the company's ever become profitable. So I like to couple the technical breakout with a fundamental backdrop. Now, sometimes we might not really know why a stock is breaking out, but if it's based for a long period of time, which I'll show you in a minute, typically that base I like is a 6-month or a 12-month base, and it's consolidated after selling off. Here we can see, and then it breaks out on the green line on the far right above its previous 6 months. I like that. And I like that for a specific reason, because investors are not in this stock. I like stocks that potentially had a deep V sell-off because the shorts are now in that stock. They're piling into the short side. Medium-term investors are probably out of the stock. So I like where the story starts to change, and then you get that breakout. Investors will come back into the stock, propel it higher, shorts have to cover. So that really makes a good breakout. We talk about breakouts specifically in another video, so go back and watch that if you haven't. All right, I also like average true range, and I like it because it helps to reduce the daily random fluctuations, because it uses the open, high, low, close on many different periods, and it takes the open, high, low, close, and then it uses it on a look back. So I like ATR as an overlay on the charts, not as an oscillator. Going back, let's say 5, 10, 20 days, and it helps me smooth out the noise so I can get a better visual of what is happening with specific breakouts and potential breakdowns, and it removes the noise. Now, we talk about ATR in some other videos. We don't want to go in and complicate things too much here, so please go back and watch some of those other videos. All right, and again, the average true range really helps when you start to get these gaps in a wild market that really just is all over the place. And again, it helps smooth out the daily noise and the randomness. All right, so support resistance, I'm sure many of you know this. It's very simple. It's where the accumulation and distribution of buyers and sellers have come into the stock. So larger support areas, you had more accumulation. Bigger resistance areas, you had more distribution and sellers of stock. And it makes perfect sense. But support and resistance today is more important than ever because quantitative managers, not that they're necessarily buying and selling on it, which many are, they're also de-risking portfolios. So big trend following quants, if you break below, let's say an S&P or the NASDAQ support level, they will start de-risking their portfolio because they need to align their volatility based on what's happening with the overall market. So it's very important to know the bigger resistance levels and bigger support levels. So if they don't have enough risk on and the S&P is breaking out, you need to be aware of that because they will come in the market and start buying the market because they need to add risk. Again, the retail investor has an advantage that the institutional and the professional doesn't. Their advantage is you are not competing against everybody else where you need to raise assets. If you underperform your benchmark for the year, you're out of there. You, as a retail investor, do not have to worry about outperforming and chasing the market like all the other managers need to do. All right, as we mentioned again, the longer the length and the period of time, it's more important for the support and resistance. And I think many of you are already aware of this. So, for example, a 1-hour chart has a lot less data. It's going to have a lot less buyers and sellers on that hourly time frame on the support and resistance than on a longer term, maybe a weekly time frame, because you're not going to have as much supply and demand or accumulation and distribution at those levels. Because remember, longer term investors are going to put more capital to work on a longer term time frame. Okay, Fibonacci ratios. I do like Fibonacci ratios, and it's essentially a support resistance gauge. However, it's looking a little bit more extreme approach in terms of its velocity of the move. I also do like it because a lot of quants it's an easier calculation when you get a correction in the market to go ahead and program that. At least that is my theory, and that's what I have done in the past as well. And it differs, again, than the general support resistance levels that are using open, high, low, close. It's really using a retracement of its previous path and its past advancement and decline. And any standard charting package, you could just use any of these ratios. These are the commonly followed ones. And it's really just a good tool, visual to use when the market is either advancing significantly or declining in a fast, rapid sell-off. All right. Next up, a channel. I like looking at channels, and I think longer-term investors probably could use a channel to your advantage. I think shorter term time frames are hard to use a channel, but essentially in a longer bull market, it could be a weekly, it could be a month, a daily, whatever it is. You could trade the channel if it's a stock that's really strong. And what I look at and how I view it is, if I own a stock and it's really one of the bigger stocks, let's say I own my portfolio 5%, what I will do is I will sell, let's say, half the position when it gets to the upper range of the channel, and I will look to add back to that position when it gets to the lower end of the channel. And that's how I view channels. If I'm not long the stock, potentially you can get back into it at the lower end of the channel once it starts to turn up. And that's it. So it's really, again, a time frame of parallel trend lines where the stock in an upward trend or even a downward trend kind of follows that pattern. All right, moving averages. This is not something that I would say most of you already know. It's really just a look back period of the mean price, and I would assume almost everybody knows it. I don't look at moving averages. I don't look at the 200-day. The only moving average that I think from my past experience in testing that I do like is a 50-day moving average. I think it's probably the most robust where it doesn't lag too much. But again, I don't like moving averages, and I'm going to show you exactly why. And the reason why is the shorter time frames are too fast. They whip you in and out of the market, and then the long ones are they're too long and they lag significantly. Here's a perfect example, and I don't mean to pick on the good people over at Pilot Trend ETF. I'm sure they're nice people and they do a great job managing money. But this is a $3 billion ETF, and I want to show you, and it's really designed to help investors mitigate their risk. So I do understand, but I also do think that using a 200-day moving average is just, it's not a great tool for portfolio management. And here's exactly why. The fund, the ETF, will be 100% long the S&P if it's 5 days above its 200-day moving average. If the S&P is below its 200-day moving average for 5 consecutive days, it will move 50% of its capital into short-term treasuries. Then, after another 5 days, if the value is lower than the previous, it will then move 100% into the T-bills. All right, so, and then it will have to get back into the 200-day moving average once it gets back into the S&P, reallocate 100% to the S&P once we move back above the 200-day moving average. So let me show you why in actuality, with real capital, why this has not proved to be robust. Here we have the trend pilot, and this is a recent sell-off that we saw a 36% decline in the S&P, and it did a nice job right here. Went to 50% treasuries, and it only went down 19.5%. The S&P went down 36 or somewhere in that area. Yeah. All right. So, but the issue is, and again, I mean, no one knew that the Fed was going to pull out a bazooka and go ahead and inflate the balance sheet by 7.6 trillion of QE and just spark probably the fastest V-shaped recovery we've ever seen. But hindsight is hindsight. The issue is that I find that the 200-day moving average just lags significantly. So while the S&P rose almost, let's say, God, that was a lot, probably about 20%, Trend Pilot was still in cash. 20% appreciation. Why? Until the S&P got above its 200-day moving average, the index already made its move. So as we could see here, the S&P is up almost 11% for the year, and Trend Pilot is up or down 6%. Now you could say, you know what? That's a very limited data set, and it's not really a good example. Well, let's go back 5 years, and what we could see here is it's done a decent job back in 2018. It did help mitigate the downside volatility, but at what cost? At what cost did it do its job of selling out of the S&P when you fell below the 200-day moving average? Well, the S&P is up 75%. This product is up 37%. I just don't think that the 200-day moving average or moving averages do a great job. All right, now let's move on to Bollinger Bands. And Bollinger Bands really measure the volatility. It also helps to measure, I think, on a shorter time frame, really, overbought, oversold levels, looking at standard deviation above the mean. Okay. Now, I don't like Bollinger Bands either. I rather use a Keltner channel, which really is using average true range. I think it does a little bit of a better job. But there's sometimes that using a Bollinger Band, just looking at it, it could help you. Now, in theory, let's say the stock price is this dotted line here, and it really hasn't gone anywhere. Let's just say that's the mean. That's the mean price, and let's just say this is the 50-day price or moving average or whatever you want to say. So the stock is in blue, and it's moved up significantly above its mean. The green here is 3 standard deviations above its mean. Let's say the red line would be 3 standard deviations below its mean. In theory, when you hear people talking about trading mean reversion or trading overbought or oversold, the theory is that eventually all stocks revert to their mean. It's more of a simplistic statement than really in theory, because I find that the Bollinger Bands are not a great measurement for mean reversion. I often find that stocks, on the way that the Bollinger Bands calculate and incorporate this noise within the volatility, they stay overbought for an extended period of time and keep riding the upper edges of the overbought level. Now, sometimes when you get a gap up above the Bollinger Band, completely out of the range, then sometimes it mean reverts to its mean. But anyway, the point is that's what Bollinger Bands do. They help measure the volatility of the stock and look at overbought and oversold conditions. All right, so trend following. This is near and dear to our heart. As we mentioned in some previous videos, we've moved away a lot from the intraday and even the swing trading, and our partner has been a trend follower for 20 years at ChartLab Pro, and he was actually the head of futures research at Prudential. So he's been managing quantitative trend following funds for a long time, and a lot of his research and academic and real world experience has fallen into our models. And we like trend following because it allows you to capture those big parabolic moves, 30, 40, 50% over a 70 to 150 day period, and we don't need to necessarily be stressed out about the intraday moves. Plus, trend following is great because it's a little more robust than swing trading. It has more data, and essentially what in theory trend following is saying is, if the price keeps moving higher, the likelihood is it will continue to keep moving higher. And that's the same thing with a downward trend as well. So while trend following is based on price series, it's not necessarily the same thing as technical analysis. A lot of people view them as one and the same, and that's not necessarily true. And that's because trend following, the big trend has yet to really develop. And you're making a bet that the trend is going to continue to develop in the same way that it's currently just starting to make. And that's why a lot of the gains have yet to be made when you first get into a trend following trade. With technical analysis, you're looking at so much historical data, a lot of the trend has already been made. And that's why that trend has already developed a lot of its appreciation. Now, trend following is definitely a strategy, and it is a strategy of probabilities, where if a trade fails early enough, you're out. You're taking your loss and moving on. You're not going to hold on to it. And you let your winners run. And hopefully those runs will be massive runs. So it's a strategy of a lot of trades, a lot of little tiny failures, and some big gains. And that is really essentially what trend following is. We do have a much more detailed video on this, so you can watch that, but I just wanted to highlight the basic concept. All right, so this is important in terms of trend following, because a lot of people think, okay, well, if it's such a powerful signal, can you forecast how much it's going to appreciate? And you can't, because there is no forecasting with trend following. And quite frankly, I would say most of Wall Street's sell-side analysts can't forecast either fundamentals. But that's a whole different argument. What I wanted to show here is a hypothetical example. And let's assume you have 4 technology stocks, slightly higher beta than the S&P, and they all trend really well. And by the way, big cap tech trades really well and works well with trend following. And there's a whole theory behind that, which we'll get into later. And we do like crowded stocks, by the way. Those make really good trend following trades. But let's just assume all of them in the past history have done really nothing, haven't broken out, they haven't exuded any type of real strong momentum, anything. But then, boom, on one specific day where we have the red line, they all have the same type of buy signal based on a trend. Let's say that's our signal that we provide on our service. What's important to know is we're going to buy all of these and have an equal weight of all of these, because they all have an equal probability of appreciating the same. There's no way to determine which one, based on trend following, is going to appreciate more. Now, you can have a fundamental point of view why one would appreciate more, but there isn't any real way to determine what in 6 months will be higher. We're just making a bet that they're all going to be higher, and if one fails, we'll sell that and we'll keep the other 3. And that's the essential trading strategy here with trend following. It's longer term. We don't need the daily anxieties of the volatility and the random noise of day trading. So we do love trend following, as you can tell. All right, so if you need any help, please contact us, and we'll be happy to help you.